Okay, hi everyone. Today we are with Vivek Boray, and I hope you hear us well. Please write on the chat box if there is any issue. So Vivek, welcome.
Hi.
It's a pleasure to have you here today with us. You are about to share a very good presentation, a very useful presentation actually for most of the startups. So I will take you the stage, and also if you start with a short introduction about yourself, that will be very great also.
Oh, thanks a lot. Thanks to Startup Istanbul and the team for having me and everyone for attending. My name is Vivek Boray. I'm essentially a startup lawyer. Been practicing over 15 years in Silicon Valley, San Francisco, New York. Work a lot with startups from idea to exit, the whole life cycle. In addition to that, have mentored to various incubators and accelerators around the world. And also currently actually I'm helping out WeWork Labs in Atlanta as an entrepreneur in residence. So in addition to doing the legal advisory work, I also help with strategy, especially with startups coming out of the emerging markets. I have a lot of experience with Latin America, Asia, and increasingly with Africa as well. So yeah, eager to share some thoughts with you about funding your idea. This talk is going to be called Funding Your Idea, and it's meant for, I think, general audience as far as anyone who's thinking about doing a startup, or even people up to Series A or beyond. Hopefully they have something you can take away from this. Great. So I'll just get started here. So as I said, this is Funding Your Idea, an entrepreneur's manual, and give a general overview about the agenda today. So, and I want to start with the important reflections before you start up, essentially. Kind of maybe think through what's involved in those before you're thinking about your plan to do a startup. So, some of you are actually involved in doing a startup, but it's also important to kind of reflect back on these founding principles as well. And then give a brief overview of what are the financing options and how to attract and engage investors, and then deal structure, what to expect during the investment process. So it's we'll go through kind of planning a startup, what are your options to grow, and how to go through the investment process, essentially. So we'll get to it here. So starting a business, obviously, it's a big undertaking. It's a big commitment. As you know, it's energy and passion, time, financial resources, yours and your investors. Before thinking of financing, it's worth taking a deep breath and, kind of taking key questions about yourself. What are you doing? Why are you doing this? Is it to make money, lifestyle, change the world? Understand how that plays a part within the startup life cycle as well, the type of business you're doing. I think sometimes some people will get caught up in, they think it's just a way to kind of make they hear about maybe some venture funds being launched and people raising money, that is a way to make money. But I think you have to be committed to doing it for the long haul and kind of have thought through the business decisions that are involved with it as well. And so you want to think through, how long do you want to commit, and what level of financial risk are you prepared to take? Because there are no guarantees here, and it is a high risk, venture and adventure as well. And how long you want to commit? I mean, these days, I think in our popular imagination, we have the kind of late 90s .com bubble idea in our head of how a startup is, but it's not 6 months, 1 year you're doing an IPO. But in this day and age, it's more of a 5 to 10 year haul. So I think you have to be willing to commit yourself for that time period. And then key questions about the business. Be honest with yourself and the risks, knowns and unknowns. Do customers want the product or service? Oftentimes, it helps to, if you're coming from a certain kind of the context, if you're tied immediately to a context, say you were working at a big major enterprise and you faced a certain issue with a process, it was kept on reoccurring and you were frustrated by it, you saw the need that, hey, if we could build a SaaS solution around this that could cut, cost, save us time, and maybe businesses would buy this. So do you have the competence to build the product in the team? Do you have a filled out team? Do you have the tech side covered? Do you have an understanding of product? Can it be monetized? It's essentially what you're doing is building a business. It's not just enough to be wanting to solve a problem, but you're building a business. So there has to be a monetization angle as well. And how competitive is the space, or will it be? I think You want to have some competition because that at least validates the fact that there's a market opportunity there, but you want to be cognizant of that. And how big can the overall market become? Is it such that maybe only one winner is going to be there? Ideally, it's a large market in which you can have several winners and several, divisions within a market as well. So those are strategic things to consider, and they will evolve over time. There's never going to be a fixed answer, but these are things I think it's always important to kind of have these, though to have them at the beginning of your process. You want to have these in your mind, as you go through the whole life cycle of the startup. So moving on to the next topic is, what are your financing options? So two general tracks here. There's non-equity financing and equity financing are the two tracks. Equity meaning shares or ownership, percentages within the company. And so non-equity financing, self-finance, what is also known as bootstrapping. And then there's also debt and bank finance, which is not likely there for startups, especially early stage startups, might be available later on. And the other, on the equity side, there's angel financing. Angels are, high net worth individuals usually, or groups of individuals who pool together their resources to come in early, take the big risk, and fund startups. Venture capital, now these are institutions that manage money and invest in technology companies. Private equity, these happen in a later stage, and then public stock markets, involved if the company gets big enough and go public. So just talk about a little bit about self-financing and bootstrapping. Financing growth from previous cash flow and personal funds. You obviously need to have cash flows. There are examples of bootstrap companies that maybe grow out of consulting practice that have a cash flow there. Bootstrap companies almost always spend cash more effectively than equity finance companies because you're watching your own money sometimes. Depends how you are with your own money, but already being close to existing customers give excellent ability to understand problems and to find good solutions. But you don't have the cash kind of powder to for product development, marketing development, quick hiring. And especially when you do find that product market fit, you may not have that ability to scale up quickly, it's of the essence in a startup. So debt, bank finance, now this is limited funding. A lot of banks will want a security. If you're early stage startup, your IP, no one knows if it's worth anything. Banks need predictability. It's not useful for a startup. I think until you raise a Series A or Series B, this is not really a good opportunity. So it's not really relevant for the seed angel Series A context. So really what we're going to be talking about most, the rest of this conversation is going to be about equity financing. And, good reasons to raise equity financing. This means going to angels and going to VCs and that whole typical startup life cycle, that funding cycle that you probably have heard about. And so just kind of general rules of thumb here, prerequisites for going out to raise equity financing: unique product or concept, passionate founding team, and large potential market opportunity. This means that there's intense competition most likely, and there's a need to move rapidly. So, and when do you go for VC funding? Why do you go for funding is essentially 6 areas that they're really going to help with: hiring, rapid product development, partnerships, oftentimes, especially as you move into more institutional VCs, or even angels, if they're well connected in the industry, they might be able to make that phone call or place you with the right people with different potential customers. And it also can serve as validation as you go and pitch customers. Help with infrastructure, internationalization, especially it might be a fund coming from a strategic market that helps you enter that market, and also with commercialization as well. So it's also not just money they're providing expertise and thoughts and ideas that help you strategically scale as well. And so when not to raise VC, I think it's important to kind of think about this. Application is not a feature. Is a feature in our product. What does that mean really? Essentially is what you're building. Essentially, I think the way to think about it is is this a product? If it's a product, is it, can it be monetized in some respect? Many ways. Or is it something that can just be added on to something that's already being monetized? If the market size is too small and the motivation is not financial, meaning that it's fine to start a business and not to want to make a certain lifestyle out of it. But you have to understand with angels, but especially VCs. These are institutional funds. They have limited partners who invested in those funds who want to receive a certain return at the end of the life cycle of the fund. So they want that your business to kind of grow a certain way. If they're raising it at a $5 million valuation today, they want to see that become a $100 million valuation, at a certain period of time. And that means certain things with regard to how you run the business and motivations and timelines and just how things are generally conducted. The risk is that you waste time unsuccessfully trying to raise finance. It's not that necessarily. It's like the real danger is that you do succeed in raising VC funds sometimes without thinking through the implications of what that means. Because if you bootstrap the company or just raise some friends and family money, you have a certain amount of flexibility as far as what a successful exit is. When a VC comes in, they want to see a certain level of exit that meets their own financial metrics. You lose the opportunity to run a lifestyle business, and they would be certain measures into the agreements that you sign that would lock you into the company. Your equity, your ownership would require you staying there for a certain period of time. And usually that period is around 3 to 4 years. So important things to think about. And so just a general landscape of what an equity financing, these numbers do shift from market, but seed is usually up to $1 million, $2 million, various grant funding, university funds, friends and family, angels. Now some VCs moving into that area as well. Early stage Series A, then growth capital, 2 to 20 million or even more. The early stage and later stage VCs, usually same people will be in both groups. And then you have your private equity buyout type people in the later stage as well. So the next question we're going to move on to is how to attract and engage investors. I just want to give, kind of building off of that, how the finance ecosystem works. And so this is the U.S. startup ecosystem, which runs on equity capital. So you have at the top here pension funds, endowments, sovereign funds, corporations, family offices. They invest, I think figures from 5 or 6 years ago, $41 billion into 253 different funds in the U.S. for that year. And they come at a certain point at the beginning. You have incubators, angel, friends, and family. Up to that 5 year, then 5 to 10 years, usually a lot of funds will try to exit in some way, either through an M&A, IPO, or sales on the secondary market. And so then the 80% will come back to the fund, to the split amongst the LPs, and 20% would go to the fund managers, then go to the founders. And so it's a cycle that generally how it works in the US. And then this is how, I think what builds the ecosystem, especially in a place like the US, is that, people save, invest, then you have an exit, and then these founders then, in a sense, become VCs as well, or angels as well. And so this is how it works with many types of entrepreneurs, is you'll find a company, you'll become the CEO, you'll then maybe get more money, become an angel, then you maybe you could become a VC at that point or have money to invest in a fund. And so this is how that cycle kind of builds on itself. And what you have in Silicon Valley is really 30, 40 years of this process being played out. And so in the US, what you have, just a reminder, is you have access to growth capital, essentially, is what's attractive about that market. Now, the difficulties of startup financing in non-US startup ecosystems, now it is changing, and this is just an example from Europe in 2016, 10 billion. So there's less money, that gap there, between your after first couple of years and then getting into the later stage, that is a difficulty. So this is also important to keep in mind as far as like building out your business, thinking about your business plan and how you raise money, because depending on the market you're sitting in, you may not have the option of as much growth capital you access. So maybe monetization becomes more of a greater concern for one. So just kind of overview of venture capital, how the VC makes money. They raise funds, every 2 to 4 years. They invest money over 3 to 5 years. And this is kind of just a generic breakup of the general trend. Half of the investments lose money. 1/3 of the investments break even. And 1/6 of the investments make lots of money. And so that's really what ends up happening is a lot of funds, they'll find their 2 or 3 winners and they'll really just be investing in them from A, B, C, all the various rounds until the exit. That's really where a lot of funds will make their money. And there's a very small management fee that that the partners take. And then really what they're shooting for is the carry, is the return of the total amount of capital return from their investments, usually in the 20 to 25% range. And that's really what they're shooting for. So they're very exit focused. So that's very important for you to understand when you're talking to a VC, is they're viewing your company, what you're doing as a financial instrument. Like, how can I push this to an exit is really what they're doing. So angels, how do angel investors make money? Unlike the VC, the angels invest their own money. Much smaller absolute returns can be very meaningful to an angel. So I think they're usually, a lot of times, it's school alumni groups or groups centered around, promoting women entrepreneurs or, entrepreneurs from underrepresented communities and the like. So angels can have, they invest a small amount at an early stage, low valuation, and they might, exit at the Series A, sell some of their shares then to an incoming investor, or hold on to, for the long haul. Angels can be important. I mean, I think as far as like good, smart money, they can also be advisors as well, who put some money into the company. So, and also they can be good bridges between you and VCs as well. So, in their own networks. So I think that's a key thing to keep in mind. So just drilling down a bit deeper into the VC world is like what a good VC will add. Many things, advice and strategy, hiring, developers, country managers, your C-level people, partnerships. They help with your profile and PR, further access to capital, your relationships, exit strategy, internationalization. So I think as you talk to VCs, it's important to diligence them. Just because they're sitting on money doesn't necessarily mean they'll add value. You'll want to talk to other companies they've invested in and see how good of a partner they are. So you want to really think of this thing as a kind of partnership. And what do investors look for? I mean, I think there are three key components: team, technology, and traction. Are they, exceptional, good, or mediocre, or incomplete? And, of this three, many times, the third, traction, really, if you're showing the right numbers and growing in a certain way, the first two can kind of be team and tech. I mean, most of VCs may not even understand the tech, but if you're showing traction, that's really, I think, what I've noticed you've had the most leverage. And team, if you've had a track record of being successful before, worked with on startups before, had exits before, that can also add a lot. Now, within tech, if it's certain kind of deep tech areas or biotech, or if you hold key patents, there are certain funds that specialize in that area. If they really value that could be something of great value as well. So you want to, as you go through the process, hopefully, you would have built your startup, got the product, it's growing to some extent. You raise some seed money. Now you're ready to talk to VCs. So the key thing is you have to understand, better than I do, is your most valuable asset is your time. It's the most valuable resource you have. So you want to have strategy. So you want to begin to identify relevant VC partners. And as this world grows, that, say 5 years ago, and, each market's going to have more and more kind of VCs coming to the game over time. So you want to think about who has the funds to invest. Are they a match to my size, stage, and geography? Do they have a relevant portfolio? No directly competitive investments, and how good is their track record? You want to be focused in this approach. And the great thing is, with Crunchbase, AngelList, various resources out there, you can spend some time on this, kind of a few hours in a day, and also begin to see the patterns of like who really invests in your space. And if you're not really finding good, relevant investors, you also may want to consider, are you approaching it the correct way? But I think it's very good to have, because also when you engage investors, you want them to understand your space, and so that the feedback they give, even if they decide not to invest, is relevant to what you're trying to do. So I think it's very important to create a short list and strategize this process. And so how do you get on the radar screens? So you've identified the VCs you want to talk to. Kind of a cold email, you can do that as a last resort. You may want to build some context. So analyze the portfolio companies they've invested in. Do you have connections there? Analyze the contact network and advisors, press coverage. Try to build up a profile and blog conversations. Attend events and conferences that are pertinent to you. And relevant PR, strategically can also be quite useful. As I said, with the traction point, VCs spend their time looking for businesses with momentum. I cannot overestimate this, enough is the sense of FOMO that a lot of VCs have, a lot of investors have. They want to feel that they are, that they need to invest in this company because this is the moment and they need the capital and this is going to grow quickly and grow great. So you want to try to build that as much as you can in a credible manner and then use that to get noticed by VCs. So you're in this process now, you're talking to VCs. So we're going to talk a little bit about deal structure and what to expect during the investment process. So this is just sharing relevant information, with the VC pre-first meeting. Yeah, depending on your familiarity, the business plan as traditionally known is not really a thing in the startup world. You usually want to just have, one-page summary and then like a 10 to 15 slide PowerPoint slide deck. Clearly answers the main questions is best bet. Talk about your product, your market, your business model, your team, competition, product roadmap to tech, and biz dev and financial status. And pre-term sheet, there'll be some meetings and things like that. And these are just ballpark figures, but 2 to 4 weeks. And then after that, you will usually get into the term sheets phase and then move into definitive legal documentation. So types of investment, just kind of maybe getting a bit more into the legal terms of this. So at least you have some familiarity with this if you've never dealt with this before. Avoid common stock investments, inflates your common stock price and limits your ability to incentivize your team via equity, via stock options, because they're receiving common stock there. When you're doing angel or seed investing, there's an option to avoid the whole rigmarole of preferred stock investing and to just do a convertible loan or a convertible security, a safe. It's good when time is of the essence and you don't want to spend a lot of money. The loan will convert usually with a discount. The safe might also convert at a discount. There might be a fee cap, a valuation cap as well. And the whole point is with these things is to keep it as simple. So really, what you really negotiate is the discount, if any, and the valuation cap. And a lot of these documents are, the Y Combinator safe is free and available on the internet, on the Y Combinator site. And a lot of people just use that for their early stage financing. And preferred stock investment is a typical structure used by seeds, VCs, and occasionally larger angels investing as a group. You try to rely on standardized forms. I think this is kind of connected point why when you structure your company, you would want to use, for a variety of reasons, it's better to use, they say, a Delaware company or an English company or something in a jurisdiction that has had some VC activity so that you can rely on certain standards. A lot of the process has been standardized as far as at least starting points or what you negotiate, which allows the process to go in a much more efficient manner. So I think that's quite key as well, and also will help you attract a more global base of investors potentially. So understanding a term sheet, it's between 2 to 15 pages. It's going to have sample phrasing like this. You'll kind of get into spelling out the key general points involved with the terms of the financing. It's meant to simplify the process. It's not meant to replace legal documents. It's made to make the legal documentation process go quicker. And usually between 2 to 15 pages. Of course, do not sign anything until you've had your lawyer look at it, no matter how friendly the VC is. Because even though a term sheet is not binding, most of it is not binding, it's only going to have confidentiality and maybe exclusivity provision that's binding. So you can technically renegotiate everything. If you should sign a term sheet and there are terms in there that you would not have agreed to if someone had explained them to you, it can be brought up later on. The investor will use it sometimes to beat you on the head that you should accept this because you signed the term sheet. So before you sign anything, the term sheet, have a legal counsel look at it and advise you on the contents of it. And so this is kind of just like an overview of a cap table, how it looks, and this will be part of the term sheet. And what you have usually is you have your founders coming in, then the investors will create more shares, add that on. So this is more of a U.S. English style looking cap table. You have your employee option pool. So of course this makes sense in context, but this is kind of just a general shift. So you'll see that post investment, the founders would receive, depending on the valuation, a certain amount of dilution, and then the investors might ask for an option pool to be created, which also further dilutes the founders a bit. So you want to be cognizant of these terms and understanding how much you will have at the end of the financing. So typical deal terms in a VC term sheet, there'll be usually board representation, liquidation preference, participation rights, anti-dilution, reverse vesting, certain control and veto rights, and exclusive period to close the legals. So that will be in the term sheet, and I'll go into these in a bit of detail. Going back here, so liquidation preference. So basically what that means is if there is a liquidity event of the company, usually a sale or a liquidation of the company, if there's no liquidation preference, everyone gets paid out pro rata relative to their percentage of they own in the company. The usual standard is non-participating liquidation rate, 1x non-participating, meaning that if you invest invest $4 million and the value and the exit happens, say this company didn't go so well, the exit's at 5 million, so then investor will get paid back the 4 million, then the 1 million will then be divided amongst the rest of the shareholders. So what that does is it protects the investor from downside, from an investment essentially that is at a exit that is at a lower valuation than what they invested in, but then upside, everyone is kind of aligned. So that's the usual standard. Anything that veers away from 1x non-participating, you want to avoid the situation in which the investor is getting to double dip, meaning they get paid out first, and then they also then take a pro rata portion of the remaining chunk. So it's kind of become very standardized now that it's 1x non-participating. So I think the key thing for you to understand is you should come across it. If that term is not there, you should ask some questions about it. So typically how it plays out, just people will get paid, relative to what they've, pro rata. Non-participating, they'll take out the full percentage, up say in this 5 million, if they invested 5 million, anything above the 5 million would then be paid out pro rata usually. And this is where they double dip as well. So you can kind of take a look at these numbers, and I will share this presentation so you can kind of take a look when you can. Sometimes you see this variation that is participating. So you double dip, but it's capped at 3x. So that is, you don't see that as often either. Though, you could see some of these forms come back as you go through the, kind of this COVID moment, but that remains to be seen. And anti-dilution is, essentially, it's essentially down round protection. So if I invest at a $20 million valuation, and then the next round, tough market, you then issue shares at $15 million valuation. So it's to protect against that. It's to adjust my investment so that I'm protected. Get a certain kind of greater percentage of the company due to that. So what you want to have is is the key thing to remember, like liquidation preference. Here you want to remember is broad-based. It should be broad-based weighted average. So it basically should only really apply to down rounds of outside investment. Anything outside of that is not really market. So I would try to avoid that. But given the changing times, it remains to be seen. Reverse vesting is it's relating to the value of the startup is, the concept is that the value of the startup is typically in the promise of future labor from the founders. So investors seek to secure this by reverse vesting founders, typically over 3 to 4 years. So startups, typically all founder stock, or some might be, it just does change relatively. But essentially what it means is that, you have 100 shares today. Over 4 years, there is a repurchase right of the company that is tied to those shares. So if you leave after 1 year, the company can buy 75 of those shares back at the original price. If you leave after 2 years, the company can buy back, half of those shares at the original price. So what it does, it keeps everyone locked in. And in situations in which there are multiple founders, it helps kind of keep people's interests aligned. So then I think, also on reverse vesting, want to kind of also bring in the point that it is typical to receive double trigger acceleration for your vesting, which means that if there is an exit or change of control of the company and the founder is either terminated without cause or made to leave for good reason, then the vesting accelerates 100%. So that is some protection for a founder who has spent the time and effort in helping drive the company to change of control or an acquisition. But if they get fired for no reason or made to leave for no good reason, they should still receive the upside. So what you want, also another buzzword you want to remember, is double trigger acceleration, which is very standard. So kind of taking a step back here is choosing the right VC. Valuation is important, but it's not the decisive factor. You want to think about the value at exit, the probability of getting there, and your share of business at the exit. So there are various considerations there at, your share of business at exit, it's tied to your valuation initial round, valuation dilution subsequent rounds, but you can also get, option grants later on to kind of buffer your shares. Probability of getting to the exit involves fewer strategic errors made, hiring quality and speed, type of partnerships you develop, and the product development. And the value at exit is really tied to revenues, profitability, growth rate, team quality, and strategic fit with buyer community, and a well-managed exit process. So a lot of these things, they just tie together. So I think it's very important to kind of keep this in mind as you have the discussions with investors. And key things to consider when choosing an investor, relationship with key individuals and broader team. You want to speak to other founders and you want to do your diligence. And you want to make sure the portfolio that they've invested in has relevant experience. It's not competitive, and it's a community you want to be part of. And make sure the deal terms are within market. And I think you want the right partner at a fair price as opposed to any partner at a best price, I think is really the governing logic here. And I think tying to that is, you want to have a funding plan, put this all together. Is really your kind of business plan plus fundraising strategy. And, the traditional view, as I said, is going to have all these various components in your business plan and, kind of talk about team critical risks, all these issues. But the problem is, typical, they spend a lot of VCs. I think it's a key insight. It's why it's important to get to the point when you're addressing investors and VCs. They spend at most 5 minutes reviewing a company's materials. So what are you supposed to do? Early stage, the business plan, most people don't even use it. It's always shifting. The cost is the time and waste. So keep it simple. You want to have key concepts in there, and really it's going to be your pitch. So executive summary, elevator pitch, problem, solution, market opportunity. Essentially, why should the investor care? And key concepts in that business model, as I said, it should be essentially be your PPT deck. It's really what you want to try to get to. And I think I can't overemphasize the importance of being direct and to the point. If you can't explain things in a direct, succinct way, then just you have to refine it, because people are looking for certain trigger words, whether they're interested or not, and you want to get their attention. And then as you get their attention, you get them to fill in the details. So I think it's also important to do practice pitches, talk to people who've gone through the process before, and there's tons of literature out there about it. So that's the good news. And yeah, fundraising strategy, resources, time are limited, so have a strategy. You want to think about best practices, feedback, iterate, research, identify investors. You get access through your network. The sooner the better. And you want to have kind of gotten in that flow, so that's part of your profile as a company. Within the companies, that you have someone who is tasked to this and has built these relationships with the investor community as well. And be social, expand your network, in a strategic manner. Understand schedules. Don't plan that do or die trip to Silicon Valley if you're talking to investors for mid-December or something like that when everyone's on vacation. So just kind of it's a mixture, just to have some common sense there and think through what you're doing and keep things simple and concise and have a post-pitch plan, how you want to go through it, and remember the big picture that it's part of. So kind of ran through that a little bit, but I hope that was helpful, and happy to, and as I said, I will be sharing the slides so to study them deeper and ask any questions. So I will take questions now.
Yeah, Vivek, thank you very much for
no problem.
Presentation. It has a lot of actually information, I think, useful for startups. First of all, I have a question. Could you please tell us about your just experiences when startups do wrong at the beginning, like funding their company or fundraising, etc., because they don't pay much attention at that time, and then it turns out a huge problem sometimes. Do you have any examples like that you faced?
I mean, there's plenty of good number of them that I've dealt with from time to time. I think several areas is when people are founding a company, everyone has their idea. They even might be best friends for life, and we're going to do this together. But they never take the time to sit down and think about, what role each is going to play, what the ownership percentages should be, and document that. Because I've found also that people will be doing that, and then they'll be in the middle of, at a key moment, we'll have that discussion, and that people will have different ideas in their head. So I think it's important for founders amongst themselves to communicate and get on the same page as far as formalizing the company and the structure and ownership and relative terms like that. And then I think also when they're talking to investors, as I alluded to earlier, in the term sheet process, you want to have, no matter how much the investor says and how much you like the investor, you want to have a good advisor, a legal advisor, someone's experienced in the field, review the term sheet from your perspective, and you want you want to be able to kind of think through before you sign anything. And at least have a little bit of a negotiation and within reason. And especially that's a good way to also even understand how the VC thinks about you, because if they're not willing to negotiate even on key terms and kind of at least give you that respect, that might even present future issues down the road. So I think kind of engaging the right advisors through the process and then formalizing and documenting the company structure and the various, and getting various consultants to sign IP assignment agreements, things like that, I think is putting processes in place, I think can be quite important as you're growing.
Okay, thank you. And the other questions are actually, what is the most important thing while signing a term sheet for startups?
I think, basic thing is you want to have looked at it with with your legal team, and then also maybe some trusted advisors who have gone through the process before and analyzed it from the company and the founder's perspective, and understand what powers you're giving up, what control you're giving up, but also what's market. Just getting an understanding of just thinking through that process, and then understanding being cognizant of that, and before you really sign anything, not just signing and thinking, okay, it's just words, just paperwork. But no, actually spending some time and thinking that through and making sure that you've had a chance to at least understand it from your perspective as a founder and the CEO of the company.
And how long does it take usually to sign with the VC agreements?
Post
can adjust themselves about their runways, etc.
Post term sheet or
before, just when
before. I mean, I think that's you want. I mean, usually if you're looking to raise, it can be a bit fluid. But I would budget in. If you're doing a fundraising round, if you know you're gonna need money by Q1 of 2021, it might make sense to start the fundraising process now, at least like getting the list together, starting reach out, understanding where you are as a company, what would be a good option or not. So I think, in this climate, especially, I'd give yourself as much time as you can, maybe even 6 months or so.
Okay. Another question is, which countries' regulations are better comparably to sign investment agreements?
When I say that, I guess better or worse, it's a value term, but I think it's just which jurisdictions have had the most experience. So, where does the terms most standardized? So you have predictability. Yeah. So obviously the U.S., Delaware, just because the long history of doing these types of deals, and that everything from the SAFE to even up to Series A is, you can get the form documents literally right now, can download them, can read notes comparing why this term works or why that term doesn't work, what's more pro-investor, what's more pro-company. So it's all kind of very transparent, and people who practice in the area know there's a kind of a rules to the game of how they proceed. And I certainly think, and I think as the kind of London becomes more of a hub as well, that's the case. I think, in any number of jurisdictions, you can create good documents. It's just the fact that I think what people tend to be their own kind of comfort level with the documentation. But that's why, since given the frequency that it happens, the documents associated with a Delaware corporation would probably be the best out there.
Okay, and there's a question from Sohail. Usually, what evidence of growth are VCs looking at?
I think it really just depends on the market you're in. If you're a B2B SaaS company, maybe kind of getting a few, key enterprise customers in place, piloting with them, or if they're paying you, the further along you are, the better. Obviously, if you're more B2C, then it's going to be transactions and then, eyeballs. There could be different metrics depending on the market you're in. And I think depending on the market situation, I think, for example, right now, there might be more of an emphasis placed on having traction in raising revenue or growing your funds, as opposed to just having maybe the more vanity associated, more nebulous type metrics like eyeballs or users that aren't being converted into monetization. So, but depending to who you're talking to as well, because one great example, of course, is like an Instagram. On its own, maybe if they're pitching to a VC. Before pre-acquisition, of course, it might have been hard for them to, unless the VC understood that space quite well. But then you plug that into a Facebook, it can become quite valuable. So I think the key is to understand your own market and what people have been investing on, and then kind of building your case based on that.
And another question is about these equities to give to the investors. Actually, what maximum stake do you think is ideal to give during?
Usually, they should hold at least they would hold around 15 to 25% post investment. So that you want to kind of keep that in that space, and ideally after the Series A, the founding group should still at least have 50% of the company. Is what you want to try to shoot for.
Okay, and could you also tell us the difference between pre-valuation and post-valuation?
Basically, that means pre-money valuation means before the investment money comes in. So if you were someone's investing $1 million at you at a $4 million evaluation, that means post money in that situation would be 4 plus 1, 5 million post money. So that just basically means what the company is worth before and after the investment.
Okay, and which topics should be negotiated on the term sheets? You have talked about this in general, but
I think the key things it just depends. if say liquidation preference is not 1x non-participating, then you should push back on that. Or if anti-dilution is not broad-based, you push back on that. But the key ones to look out for, especially, are those in which involve company control. So board seats. At a Series A, it is typical for the investor to have one board seat at least, but then also control the board. And then matters that might require the investor director to approve them, matters that might require the investors as shareholders to approve of them. So these types of things that like inhibit your ability to put a check on your ability to run the company on a day-to-day basis, they should be limited. I mean, you want the investor should have certain veto powers, but they should be limited to major activities, say selling the company or taking a major loan on or something like that, and should not inhibit your day-to-day ability to be, and also to pivot and be agile as a startup. So you want to avoid things like too many KPIs or milestone investing and things like that. You want to retain your agility as a company. You don't want the money to come in and then burden you with process.
Okay, thank you. And there's a follow-up question by Chris, from Chris. Would it then be fair if the founder says his 50% stake is not dilutable?
I mean, so you could certainly try to negotiate that. I mean, I think it's all about your relative, the relative bargaining power you have. But I think the founding team should try to hold at least post Series A above 50% if possible. Of course, there are exceptions, and if you are dipping below that, you can try to negotiate receiving options post the financing or in conjunction with the financing to help buffer that dilution.
Okay, and next question: if you give options to your team members, how do they get the real equity?
So the option is the right to purchase shares that vest over time. So say you're given options over a 4-year vesting schedule. After 3 years, 75% of those shares are vested. So you could either exercise by paying for those shares, at the strike price that was from 3 years ago, and you receive those shares.
Okay. And there's a question about your Twitter bio. What is the 17 doctors reference in your Twitter bio?
Is there? What's my Twitter bio?
I don't know. Is the right one? Maybe there are some fake.
Oh, yeah, 17. Oh yeah. That is a line. Yeah, that's an indie rock line by an indie rock band from the 90s called the Silver Jews. But yeah, it's a good song. Anyways, yeah. I don't know these 17 doctors. I thought it was a funny line. That's why I put it there.
Okay, great. I think we have done with the questions. Vivek, thank you very much for your time. It's been almost 1 hour. And I'm sure there will be a lot of startups who will be watching also this video afterwards and benefit from it.
Great.
Thank you very much for your time.
Thanks
and
a lot.
Hope to see you in Istanbul again.
Likewise, look forward to it. Yeah. Thanks a lot. All right.
Vivek, thank you very much. See you.
Thanks a lot. All right.
Bye-bye.
Have a nice day.